Hey, it's Brendan Fleming here, and in this video I'm going to talk a little bit about the Federal Reserve System. The Federal Reserve System was created to basically regulate the banking system to help provide stability with the economy, to help combat inflation, and also to serve as a clearinghouse for checks. When people deposit checks, they get processed in through the Federal Reserve originally. And did have a couple other aspects in there, but those are the primary goals of the Federal Reserve System. The Federal Reserve's primary goal is actually probably controlling the money supply and inflation and interest rates. These are all interwoven. Basically, if the economy is overheating, the Federal Reserve can raise interest rates. This will help take money out of circulation and help cool the economy. If the economy is slowing down, the Federal Reserve can reduce interest rates, and this will help make it cheaper to borrow and help spur the economy to grow. And in 1946, Congress passed the Employment Act of 1946, which gave the federal government a goal of achieving full employment. The Federal Reserve followed suit and made that one of their stated goals. And then in 1977, the Federal Reserve Reform Act of 1977 was passed, and this gave the Federal Reserve basically two goals. One is price stability, which is inflation, money supply. The other is full employment. These two goals are not always in sync. Sometimes these goals contradict each other, and that creates a lot of problems in the economy. Full employment is not something that the Federal Reserve really has a lot of tools to implement. The Federal Reserve does not establish any public works programs. It does not send out unemployment benefits. It does not really have a whole lot to do with employment. It is a stated goal, and they look at the monthly unemployment numbers and decide whether to raise interest rates or not based on that, as well as inflation and economy. But the Federal Reserve really can't do a whole lot to affect employment per se, other than putting money into circulation or taking money out of circulation. This creates a problem when we have high unemployment and high inflation. The main way to combat inflation is to raise interest rates. When interest rates are raised, it causes businesses to contract, people lose jobs, and so it goes contrary to the full employment idea. This problem is played out in the 1970s, where we had high inflation, high unemployment, and the Federal Reserve was not doing enough to combat inflation. Paul Volcker came in the late 70s, or maybe 1980, and he raised interest rates. And when he did that, he stamped out inflation. And then it did push the economy into a recession, but the economy recovered and we grew from that. Prior to that, we'd had better part of 10 years of stagflation, of high interest rate, high unemployment, and the economy not growing. Employment issues are more akin to fiscal policy, which would be a policy that's implemented by Congress and the president. The Federal Reserve really should not have anything to do with employment. And we need to end the dual mandate. We need to just say Federal Reserve needs to focus on inflation and interest rates and not have anything to do with employment. By having the dual mandate, the Federal Reserve always has a way out when we have bad policies, such as we had a few years ago where we had high inflation and the Federal Reserve was not raising interest rates. They could always say, well, we were trying to manage employment. And the reality is that we had high inflation, which is one of the worst problems in the country, and it causes a lot more harm than a short period of unemployment.